Today, I share our TFSA dividend income for the month of August. Let's do this. Before I jump into who paid us and how much, let's take a brief look at our portfolio's dividend calendar. You probably noticed January, April, July, and October are the heavy months, and February, May, August, and November are the light months. March, June, September, and December land somewhere in the middle. Just so I'm 100% transparent with everyone, I'll be sharing my dividend income based on when it lands in my account, not based on the payout date. In August, we received dividends from the following 6 companies. I'll go through each holding according to the dividend weight, not payout size, in my portfolio, starting with the smallest. I'll be adding up my totals along the way and see where we end up this month. Our one and only quarterly paycheck came from Toronto Dominion Bank, my favorite financial stock in Canada. We were paid $16.92 in dividends. They provide us with about 0.8% of our annual dividend income. This was a staple in our financial-heavy portfolio until I chopped it down back in winter. They continue to grow their dividends at a rate of 7.9% CAGR over the past 5 years, with a massive 12.7% increase last year. The share price has been growing over the last 5 years at a CAGR of 4.7%. I'll look to continue to add to this position as their PE of 10.7 is below their historical average of 11.4, and their current dividend yield of 4.2% is above their 5-year average yield of 3.8%. That's about a 10% difference. The market is moving down fast, so time will tell how much I'm able to add to my dividend income with this one before another stock is of better value. Before we continue, I want to say thank you so much for watching and supporting the channel so far. You guys are fantastic, and I love how our community is growing. Don't forget to hit that subscribe button to officially become part of the Mr. Financial family. From here on forward, we were paid by our monthly payers. First, at $23 is our one closed-end investment fund we have, Canoe EIT Income Fund. It provides us with 3% of our yearly dividend income. My yield on book value is so high at 11.15% that I can bite the high cost of owning this income fund. For those that have seen a few updates, no, I'm not an income investor, nor do I plan on it. I'll keep this on the back burner and use the monthly distributions to purchase other high conviction stocks I have in our portfolio. And if the time is right, I'll dump my shares. I know I sound on repeat, but nothing has really changed for me. This fund is heavy in value stocks in Canada and the US, so I have no worries about the fund continuing to pay that distribution indefinitely and holding long term as well. This brings our total to $39.92. Our next dividend received was $38.22 from Pembina Pipeline Corp. It pays us 4.9% of our yearly dividend income as one of 3 in the energy sector. This stock is trading well below its 5-year average yield of 5.7%. Its board approved a 0.75 dividend increase, which should be paid out in October. I was expecting it. That represents a 3.6% increase, bringing it to 21.75 cents. Despite that small increase, it still has a 5.8% 5-year CAGR on its dividend. The energy sector has dropped after reaching all-time highs at the start of June. I think the oil sector is under a lot of pressure, all commodities really, which, as I said last month, I won't get into. I think everything in the energy sector should continue a downward trajectory for the next while. I'll continue to take these dividends and reinvest them in other better value dividend growth stocks until I see PPL hit the rule of 12 again. So at the halfway point, we are at $78.14. By the way, if you want to know how I analyze stocks before I buy them, please let me know in the description below and I'll make a video about it. Next, we were paid $44.61 in distributions from SmartCentres Real Estate Investment Trust. They provide us with 5.8% of our forward annual dividend income as one of 2 companies in the real estate industry. This is a staple in our turf portfolio with its monthly distributions. I gladly hold this in our TFSA since we don't have to worry about the tax headaches of holding REITs in our taxable account. They are trading slightly above their 5-year average yield of 6.1%, with a yield of 6.3% at the end of August. This could mean it is around fairly valued right now. It is below my yield on cost. They haven't raised dividends for almost 3 years, and I don't expect them to anytime soon. They own many properties that will be densifying in the future, so there is much potential to bring back the 3% raises that they used to do in the past. I'll continue using their monthly distributions to reinvest in SmartCentres when, or if, it pulls back again like it did in June or early July. With our third biggest pair, we break $100 at $122.75. And now for our largest holding, RioCan Real Estate Investment Trust. They paid us a distribution of $64.76 across 3 accounts. This company provides us with 8.4% of our forward yearly dividend income, which is a little rich, but I like it. It has a 5-year average dividend yield of 6.16%, which is drastically higher than the current yield of 4.9%. This is mainly due to RioCan slashing the dividend by 33% back in 2021. And many of us felt it. When the dividend is back to 2020 levels, hopefully within the next 2 to 3 years, this will provide a yield of 6.9% at current prices, which have been stable around $20. This could indicate it is still undervalued. They already increased dividends 6.3% this year, or half a cent. With the uncertainty of interest rates, the global supply chain issues, and the possible pending recession we hear in the news every day, REITs have pulled back with the overall market. I'll keep dripping this all I can at this great valuation, 20% below its NAV of $25. I see this as a core holding for stability and incremental income growth as RioCan adds density to their properties. Their earnings report in August gave me more confidence in this long-time hold despite the worsening economic conditions. This brings us to a total of $187.51. Lastly, we have our monthly financial pair, First National Financial. We receive $66.58. They provide us with 8.4% of our annual dividend income without their special dividend. This stock has tanked since mid-2021 and continued to drop with the overall market. It bottomed out under $33 a share with a yield of 7.2% at the end of June, only to rocket back to $38 by the end of July, and has hovered within a small range all of August. FN currently provides a 6.3% yield. With a 5-year average of 5.6%, this is technically undervalued still, despite the run-up. I am comfortable adding to this position again on a pullback, despite the general sentiment about the real estate market in Canada after their earnings report. I like to accumulate fundamentally strong companies when they're out of favor, or their industry or sector is as a whole. It also has paid out 5 consecutive special dividends in December. By the looks of it, after their earnings, and now the worsening real estate market, I don't see First National distributing any more cash this year, and freezing the dividend growth too. I rather they grow sustainably than make a bad situation in the economy a problem for them. So after 6 paychecks, our grand total is $254.09. Our top 3 dividend payers accounted for $175.95, or 69% of our dividend income for the month of August. As we grow the portfolio, this should moderate down to about 50%. As I always say, I never want to be too dependent on any one stock to help my portfolio grow in the event of a dividend cut or divestment. As you can see from the breakdown, no one industry or stock dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. After being shut out for 2 months, we finally had a dividend increase this month. Capital Power Corporation, ticker CPX, had a 6% dividend increase to $2.32 a share. This increases their dividend streak to 8 years. With the raise, we added $34.19 to our forward annual dividend income. It was about time. Our little ducky was finally broken. So far this year, we have received $5,828.44 in dividends with a yield on cost of 6.61%. Our forward annual dividend income is $9,321 and growing fast. We expect our dividend income to continue to snowball as we drip and stay completely invested, putting those dividends to work for us. My dividends are my little minions that work hard for me when I can't. With our minions working hard for us, we can forecast where we will be in about 10 years. I hope to outpace this forecast as the TFSA contribution room grows in the future, especially with the high inflation we're fighting. Next month, we should be seeing some major price action with the CPI release and potential 0.75% interest rate hike. So hit that notification bell so you don't miss out on a future update. And please help my personal YouTube inflation by smashing that like and subscribe button. Thank you so much for watching. Until next time, I'm Mr. Financial.